In this lecture, we're going to look at the different types of nonprofit financial statements. The statement of activities is one of the main financial statements of a nonprofit or not-for-profit organization. A nonprofit statement of activities is issued instead of the income statement, which is issued by a for-profit business. The statement of activities focuses on the total organization as opposed to focusing on funds within the organization and reports the following: revenues such as contributions, program fees, membership dues, grants, investment income, and amounts released from restrictions. It also reports expenses such as major programs, fundraising, and management and general expenses. The change in net assets results from the differences between your revenues and your expenses. The statement of activities will have multiple columns in order to report the amounts for each of the following classes of net assets: unrestricted, temporarily restricted, permanently restricted, and total net assets. It used to be called the income statement, and many nonprofit organizations produce a variety of versions of this report, calling it various names such as a budget report, profit and loss, income and expenses, and so on. No matter what it's called, the statement of financial activities shows the nonprofit organization's income and expenses for a specific period of time. The report reflects the changes to an organization's net assets resulting from income and expenses that occurred during the current fiscal year. The results of the year's activities result in a change to the organization's net assets. Thus, the statement of financial activities and the statement of financial position reports are related. Net results in unrestricted, temporarily restricted, and permanently restricted financial activity for each year are accumulated on the statement of position and shown as changes, increases or decreases in those net asset categories. The relationship between the statement of activities and the statement of position is shown on the screen. Net assets is defined as total assets minus total liabilities. In a sole proprietorship, the amount of net assets is reported as owner's equity. In a corporation, the amount of net assets is reported as stockholders' equity. In a not-for-profit organization, the amount of total assets minus total liabilities is actually reported as net assets in its statement of financial position. The net assets section for the nonprofit organization is divided into three classifications: unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. The change in these net asset classifications are reported in the organization's statement of activities. The statement of financial position used to be called the balance sheet. Although the name of this report has changed in the nonprofit world to the statement of financial position, the concepts and equations are essentially the same as any business balance sheet or statement of personal net worth. Assets are what you have or what you owed, minus liabilities, what you owe to others, equals your net assets, what's left over. The statement of position reflects the overall financial position of your organization at a given moment in time. It is the report that shows the accumulated results of all the individual years of your organization's operations put together. It is important to learn how to read and understand your organization's statement of position report. The first major category we're going to look at is assets. Assets are what your organization has, what is owed to you, what you have invested in, and what you have deposited with others. So what you have can consist of the following: cash and bank accounts, investment accounts, and petty cash; things your organization has bought for future use, such as a merchandise inventories or supplies; fixed assets, such as furniture, equipment, and improvements to your facility listed at cost that are non-liquid as the cash has already been spent to acquire them; accumulated depreciation, indicating the extent the fixed asset has decreased in value as it is used up over its useful life; collection of art, artifacts, other valuables related to your mission; payments your organization has made for goods or services that have not yet been received or used, such as annual insurance premiums that could be refunded to you if you canceled, or expenses relating to future fiscal years paid in advance. Long-term investments of unrestricted or temporarily restricted funds. Long-term investments of permanently restricted principal, such as endowment funds that cannot be used for operations. So what are some examples of what is owed to you? Grant awards promised to your organization but not yet received. Revenue earned from services provided by your organization for which payment has not yet been received. Loans your organization have made to others. Some examples of what you have deposited with others. Deposits your organization have paid to others and is held by them on your behalf, such as advanced rent, utility security deposits, payroll bonds, and so on. Assets are usually listed in order of declining liquidity. Short-term assets are those available as cash or equivalent within 1 year, and long-term after 1 year. Assets are a natural debit balance, meaning that in any accounting entry, a debit to an asset account will increase it. A negative number in the asset section of a balance sheet is unusual and should be questioned and explained. The exception is accumulated depreciation, which, as noted above, is a contra asset account that tracks the depletion of the value of fixed assets as they are used. So what might you want to ask when looking at the asset balances? So if we look at cash first, we want to ask the following questions. Do we have enough cash to pay our bills? Is there too much cash in non-interest bearing accounts? Are our investments diversified per our investment policy? Have we protected the restricted funds? Is our cash balance increasing or decreasing? Now for the account pledges receivable category, we want to ask the following questions. Are we collecting what is owed to us in a timely way? Are there any we will never receive? Do we have an allowance for doubtful accounts? What are current versus long-term portions? For prepaid expenses, we want to know, are we preparing for future programming? And for inventory, we want to know, do we have too much on hand, or is the inventory too old? Do we need to replenish our inventory? And then some other questions we may want to ask. How much of our assets are held by others, and for what purpose? For fixed assets, have we invested enough, too much in property and equipment? Do we need to upgrade our equipment or technology? And how much did we invest in capital assets during the year? Now we're going to move on and take a look at liabilities. Liabilities are what your organization owes to others or holds on behalf of others. So what you owe could be things such as vendor accounts payable on company credit cards, payroll liabilities, accrued expenses, the amount assessed from a bank line of credit, short-term or long-term loans, and then what you hold on behalf of others, deferred revenue or refundable advances, conditional contributions. Liabilities are presented in declining order of its maturity. Short-term liabilities are those due within a year. Long-term liabilities are multi-year loans such as mortgages or other funds borrowed by the organization and payable over more than 1 year. Liabilities are a natural credit balance, meaning that in any account entry, a credit to a liability account will increase it. A negative number in the liability section of a balance sheet is not normal and should be questioned and explained. So what are some of the questions that you should ask yourself when looking at a liability? The first we'll talk about are the accounts payable or accrued expenses section. You should ask the following questions. Are vendors being paid in a timely way? Do we have enough cash to pay our bills? Are we carrying balances on high interest credit cards? How long have we had these liabilities on the books? For payroll liabilities, we might want to ask, are we meeting our tax liabilities in a timely way? For deferred revenue or refundable advances, we might want to ask, are we recognizing revenues as they are earned? Are we sure no restricted contributions are included as deferred revenue? For conditional contributions, we can ask, can we raise the matching funds, meet the condition that gives us the right to the funds? For a line of credit, we would want to know, do we have the means to repay our line of credit? Are we strategically using our line of credit? Are we using the line of credit to meet our operating expenses? And then for loans and mortgages, we would want to know, how much has the organization borrowed? Is the loan internal or external? Is there a plan for repayment of the loan or mortgage? In the last category are net assets. The net assets of a nonprofit organization are equivalent to the net worth of the organization. Net assets can be liquid or fixed or long-term. Generally accepted accounting principles call for an organization's net assets to be classified as unrestricted, temporarily restricted, or permanently restricted. Small and mid-sized nonprofit organizations do not have permanently restricted net assets such as endowments, and is usually not advisable, as having an endowment ties up a lot of cash that is not accessible to the organization for operations or program delivery. It is far more advisable for small and mid-sized nonprofits to build a working capital or operating cash reserve fund before attempting to create an endowment. If a small or mid-sized nonprofit does have permanently restricted net assets, such an endowment, these net assets usually comprise long-term investments and are not considered liquid. Temporarily restricted net assets comprise contributions received or promised to the organization that carry a donor-imposed restriction as to when, time restriction, or for what purpose restriction, the funds can be used. Funds that are carried over to the subsequent fiscal year for either restriction are shown as temporarily restricted net assets. All net assets that are not permanently restricted or temporarily restricted are unrestricted and can be used by the organization as its board sees fit. It is useful, at least for internal financial management purposes, to separate liquid from non-liquid unrestricted net assets in order to have a better idea of the organization's liquidity, the financial resources it can use for day-to-day transactions. The statement of cash flows is one of the main financial statements. The cash flow statement reports the cash generated and used during the time interval specified in its heading. The cash flow statement organizes and reports the cash generated and used in the following categories: operating activities, investing activities, financing activities, and supplemental information. So what can the statement of cash flows really tell us? Because the income statement is prepared under the accrual basis of accounting, the revenues reported may not have been collected. Similarly, the expenses reported on the income statement might not have been paid. You could review the balance sheet changes to determine the facts, but the cash flow statement already has integrated all of that information. The cash from operating activities is compared to the company's net income. If the cash from operating activities is consistently greater than the net income, the company's net income or earnings are said to be of high quality. If the cash from operating activities is less than net income, a red flag is raised as to why the reported net income is not turning into cash.